Hello, everyone. Oh,
Sorry about that, Wade.
go ahead, David.
Everybody. Welcome to the February 2025 Real Estate Market Update. We're happy to have all of you here and, watching in the future as well. So, Wade, I'll go ahead and let you take it away for our presentation.
My apologies, David. Thank you for the intro. We're very excited to have Steve Davis as a guest today, but unfortunately, he's not going to be able to make it. So, Jeff and I will do our best to keep things exciting and keep a lot of great information going. Jeff is also feeling a little bit under the weather, so if his voice sounds a little bit off from his usual velvety pipes, then you'll know what's going on. Anyway, there is a lot of great data that we want to cover today. So we could go to the next slide. All right. You guys, most of you know who Jeff and I are, so we'll go to the disclaimer. We are presenting this information for general information purposes only. We're not making any investment recommendations. You're responsible for doing your own due diligence, and this is purely for informational purposes. Next slide. Real quick, we do want to cover the Catalyst value proposition. We are passionate about being your one-stop shop for hard money and permanent financing loans. We are real estate lenders built by real estate investors. So we, most of the people on our team have been, involved in real estate lending or doing real estate investment deals on their own for a really long time. I personally own a good bit of single family. I really believe in the category. So we're passionate about bringing that expertise to help you succeed. We've been involved in thousands of transactions over the years. And there are two key categories that I think want to make sure you know that we do offer. And that is DSCR loans, which are debt service coverage ratio loans, which are loans to people who cannot maybe document all of their income. It's an excellent product if you want to add single family 1 to 4 type real estate into your portfolio and you don't have that documented income to take out with a conventional loan that a lot of people do pursue. We also offer cash out refis on your primary. A lot of people are doing those right now because the market is really frothy and things are going well. So if you want to get into the game and you don't have as much cash as you need, you should take advantage of that cash out refi, which we can do on your primary residence or any properties you have in your portfolio. Anything to add to that, Jeff?
Yeah, the only thing I was going to say was you mentioned that most of the staff has done deals. I know there's a lot more national lenders these days. And so one of the benefits of working with our team is that, like to your point, almost all of the loan officers have done deals as well. Obviously in the support staff, with a national lender, you're a bigger lender. You may just get, a random guy that's probably never done a deal before. So, not that you can't do this job without doing it, but it does provide an extra level of expertise when you can have conversations, especially if things are going sideways, to kind of help pull you through that you would get from our team, as opposed to maybe a national lender that doesn't have that.
That's a great point. And also just have that local expertise, right? A national lender, they're not going to have the understanding of the Texas markets, which we primarily lend in. We do so many transactions in Houston, San Antonio, and Dallas that we just have a good feel for the market and what's working well. We'll be able to give you insight, like on the strike team. That's a big thing you want to be focused on in San Antonio or in Dallas, where the hot deals are going north of town, just these little insights that we have from doing a lot of deals. You just can't get that from a national lender. So that's a great point. All right, let's deep dive right into Houston, which is where our home office is. The data has been incredibly resilient here in Houston. If you look at the average sales price year over year, up 4.4%, 46.5% increase since pre-COVID. So since January 2019, we're talking little over a 5-year period and just amazing results there, almost 10% annualized. And some other categories that are, not as good as they were in the past. You look at the months of inventory, pre-COVID, 3.7, last year, 3.2, up to 4.3. So definitely an increase there. Also, the days on market is less than pre-COVID, a little bit more than last year. So that would tell you that the market is a little bit slower than it has been in the past, but still very resilient overall. And the average lease price being up 2.6% year over year is a solid number as well. So steady Eddie. That's what Houston has been for a long time. They didn't have the big jumps that Dallas or Austin did, but incredibly consistent. What else are you seeing there, Jeff?
Yeah, I noticed that Houston had the highest year over year price jump of all this. And not to spoil the next three slides, but Houston has the highest average sales price jump year over year. So, I mean, we saw a massive run up during COVID. Rates spiked last year, but things have kind of held steady, right? Things have you haven't seen this massive overcorrection by any means. Houston has been, like you said, very steady, and it's proving to be, at least this last month, is proving to be the highest sales increase year over year. So it's very solid, very stable. I was talking to somebody from out of town, and just the good thing about Houston is that you don't have massive run-ups or massive rundowns. It's just the fundamentals are extremely strong. It's just very steady.
Yeah, that's absolutely true. For a while there, Dallas was the lead horse and outperforming everybody, but still since pre-COVID, they're up the most. But in the last year, definitely, no doubt, Houston is significantly better than any of the competition in this year-over-year number. And that's not just this month; it was the previous month as well.
Yep.
Speaking of which, let's check out Dallas. Dallas, you can see year-over-year, both average and median, right around 1% increase, whereas Houston was a good bit higher than that. It's interesting. The months of inventory still is lower than Houston, but the days on market is higher. So some of those predictive trends, month of inventory, days on market, I think those are always excellent trends that tell you where the market's going. Those are still strong numbers. You think about 6 months being equilibrium. So it's still a seller's market with 3.5 months of inventory. But at the end of the day, Dallas has not had the best last year. Now, if you look at it, Houston 46.5, 46.4 increase since pre-COVID, and Dallas just crushes that at 67.8, 62.5. Like nobody's had a bigger run-up since COVID than Dallas. But, steady Eddie, Houston is starting to have more increases in the last year.
Yeah. I mean, Dallas is, like I said, Houston is trying to catch up. But even with them, if you consider the fact that they had such a massive run-up last year, and they're still positive this year, there hasn't been like that Austin correction where you start seeing negative numbers. They're just much smaller increases to Dallas for sure. The other thing I always look at is the rents, right? The average price in Dallas is $2,500 a month. That's extremely strong. Like I said, if you look at the COPE 6 years ago, that's a $600 increase. Even last year, we've been I'm sorry, not 600. That's 900.
Yeah.
It would have been 8 last year. So it's extremely high rent increases over this time period. So folks that were buying rental properties back then, even maybe they were saying, hey, I'm not making as much cash flow, over this run up, if the lease prices have gone up significantly. And that's kind of what we tell our customers. A lot of times, if you're looking at a deal, and we've been saying it forever, but if you're looking at a deal and the cash flow is weak, meaning, $100, not that much money, over time, these rent prices pretty consistently, increase. So you may have blips here and there, but the percentage play is to get that sucker, have the rents increase, and then when rates do go down, then you take advantage and refinance, cash out, and go buy more.
Yeah, and one other important thing to consider is that whenever you look at that rent going up 900, like as a percentage, you look over at the percentage there in Dallas, and you see that it's gone up 55.7%. And that is true in totality. But if you were making $200 cash flow back in the day whenever the rent was $1,600, and now the rents are $2,500, that's a $900 increase. So I mean, you could potentially be, if other things weren't increasing, making $1,100 cash flow. Now, we all know that's not reality. Insurance has gone up, taxes have gone up, but they have not gone up that much. And that's the power of it, is that even though that number says 55.7% up in totality, that is not the increase of your cash flow. And cash flow is king in owning real estate. So that number's up exponentially, probably 2, 3, 4x over where you were before, depending on your tax and insurance increase.
One other thing I saw, it was a map of like where to buy and where to rent. And Dallas was still buy. I was surprised. I was a little surprised by that, but it was like, hey, you can still buy properties in Dallas. I was a little surprised.
Sure. So San Antonio's next. We've been talking about San Antonio for some time, and we're going to show an article later on that shows an ongoing, constant perception from national and local prognosticators that San Antonio is a great area in which to invest. And that's probably because it's had a little bit more of a pullback than some other areas. So there's an opportunity there. But there are some numbers here that are different. You know, I mean, they're down 2%, average sales price only up 1.9%, which that is one of the few. I mean, it's been a while since we had a positive number on San Antonio for a while on that median. So that is a sign of some positivity. The months of inventory, not out of line completely with Dallas and Houston, but where you see the days on market at 83, that is a significantly higher number than in the past there in San Antonio, and definitely higher when compared with Dallas and Houston. The average lease price is flat. That's not as strong as the other two cities. The days on market on a rental at 70, significantly higher than Houston at 46 and Dallas at 54. So definitely the softer of the markets at the moment when you're looking at if you're going to flip a house in the next 60 days. But if you're saying you want to do something as a long-term hold in an area that has amazing numbers because of affordability and because of what national pundits think San Antonio is going to do going forward, I still think San Antonio is an excellent area in which to invest.
Excuse me. I agree. We've been beating up on San Antonio for a while now. However, I did notice if you look at the median sales price, which is a little more, I would say, is more relevant for investors, right? Because you're going to be dealing with the middle to maybe a lower priced tiered properties. They had the highest year-over-year increase over, well, not Austin, but over Dallas and Houston. They were higher than both. So I don't know if there's just starting to be a little bit of a thawing of the San Antonio market, maybe. With the strike team, if people are possibly avoiding San Antonio because they don't know how to deal with it. So if somebody is really smart and really good at running a rehab and understands how to navigate the strike team, I do think San Antonio is a great opportunity to pick up some properties now. They're starting to thaw a little bit. The median sales price increase being better than Houston and Dallas is a very positive indicator to me.
For sure. And if, we've talked about it a few times, but if you're new to the webinar, the strike team is a group that it's kind of like inspectors on steroids. They do a lot more broad-based investigations. If they see a property listed on the MLS, either for rent or for sale, they'll come by and make sure that you had permits. If not, might red tag the property. So it's good news, bad news story. If you do things by the book and you really know how to follow the process, there's a lot less competition right now, and you're going to have a property that's inspected. So you're getting a high quality finished product. You want to do buy and hold investing. That's a great thing to do. And it's not that much extra money. You're talking about $1,000 for permits, right? Like it's not that big of a deal. They actually are very accommodating once you request the permits. The problem is if you go rogue and do not request permits, it can be a very, very difficult situation. So to Jeff's point, if you have any questions on how to properly navigate San Antonio, our team's very good at that. We can help with some expertise, just some guidance. You have to do your own due diligence, but it is a process which can help you succeed for sure. There's no doubt.
I will say a little warning. I mean, I'm just being fair. I'm looking at the average lease price. It is significantly lower than Houston or Dallas. So if a DSCR is your exit, get with your loan officer and make sure that you're going to cash flow, or if you speak with your loan officer, if they have a product that can take you out, even if the property doesn't quite cash flow. So you do want to be aware of that. But again, I think of it as the fewer the buyers, the less competition, the better the deals you can get out there. And these are probably temporary problems that over time, if you hold these properties, rents increase, rates go down, you can really add a lot of deals, a lot of properties to your portfolio in San Antonio.
For sure. Yep. All right. Next question here is Austin. How is Austin doing at the moment? And Austin median sales price down 4.7. That is in the median category, the largest decrease.
Yep.
The others are all net positive, so that's an interesting story. The months of inventory 5.6, days on market 84. Austin is just a smaller market in general. You look at the total dollar amount, total sales, it's a lot less. It's a very niche market. There are a lot of there was a huge run up for a while there, like in the heights of COVID, whenever all the Californians were moving over here to get tech jobs, and Tesla and everybody was moving to town. It was incredibly hot, but it's just been a pullback. But I continue to see a lot of people saying the same thing about Austin. It's now back to its historical growth rate, which is higher than historically Houston and San Antonio and Dallas. It's back to that run rate because it had such a crazy run up. And I do think going forward, there's a real opportunity. Now, it's not the easiest place to buy and hold properties. You got to go pretty far outside the major parts of town. But as far as a flipper, and if you're going to own a home and see appreciation, I think you're going to continue to see that in Austin.
I agree. It's kind of, it's crazy. It's kind of calmed down, and I think it's getting back to normal now.
Yeah, for sure. Next slide, please, Dave. So, everybody's asking about interest rates. Where are they going? That's a common question. And I do watch a lot of prognosticators that are a hell of a lot smarter than me. And the numbers are kind of all over the board. You look at this, you got some people saying 6.8, some people saying 6.12. Looks like the average thought is somewhere around the 6.36 number. That's a reduction from where we are today for sure. It's not the reduction that some people are hoping for. And I will say what I've been saying for some time. I think if you look at places like Houston and Dallas, and for the most part, it's up to slightly up since rates went up. That is a really good indicator that whenever rates come down, there's going to be a ton of pent-up demand, and I think the housing market's going to do very well. That's my guess. Could be wrong, but that's my guess. So I think hanging around until rates really start to lower, if you're an investor in particular, or just an owner-occupant who wants to buy your primary residence, you're probably going to pay a lot more. And in my advice is buy now and then refi later. Could be a very good move. So,
yep.
So, Jeff, I don't know if you want to deep dive into this one, but it's just like prognostications on appreciation for next year from a wide variety of groups. Tell you, if you thought the interest rate projections had some variance, boy, this one definitely does.
I am, excuse me. I am very curious. Like the two biggest investment banks that I think of, Goldman Sachs and Morgan Stanley. If you look at the top of the chart there, Goldman Sachs is third. They can either have a 4.4 increase, and then Morgan, Debbie Downer Stanley over there at -2. I mean, they're the lowest prognosticator out there. So I'm sure a lot of smart Ivy League guys are battling, and curious who's gonna be right. But yeah, it's what is it, an overall increase of 3%? I think that's probably a little conservative relative to what historical is. I don't know, I probably know more than I do, Wade, what historical gains are. But yeah, I mean, you got a few outliers here and there, the -2, the -1, the 5, 4, but I was talking to somebody, I don't know what event it was. They're talking about is now a good time to buy, et cetera, et cetera. And it was like, in my opinion, if you want to be a real estate investor, especially buy and hold, you don't need to get cute and try and time the market. You're constantly buying. You know, when times are good, when times are bad, you're constantly buying. This tells me right here, like I said, Goldman Sachs and Morgan Stanley. I guarantee all those people are Ivy League educated when that meant something, and they completely disagree, right? So I wouldn't think that I'm any smarter than any of those guys. But I do know over time the increases are pretty consistent. You know, they may have fluctuations, but over time, it's one of the best investments you could make. And don't try and get cute and time it. Just when you see a good deal, buy it and move on to the next.
Yeah. I looked it up while you were talking. Average since
Quick.
1967 was 4.27%. So you're right, Jeff. This is a little bit lower on average. And then I think if you look at certain windows, it always depends on the exact year
Yeah.
which you select. But for the 80s, it's probably a little bit closer to 5% annualized. On the 90s, it's probably in that range. But if you go back all the way to the 60s, 70s, I think it's more like 4.27. So yeah, you're right. It's probably 25% down, a little bit more than that from the average. I think that has a lot to do with rates and the fact that the sellers or there's just not a lot of activity out there right now. But if rates come down, I think these numbers are going to jump significantly. Just don't know what's going to happen. And keep in mind for everybody, there's two ways that rates can go down. One is the Fed can impact rates, but the other way is that the bond market improves and rates come down even if the Fed doesn't lower rates. Right now, the spread is really large right now, and the spread is really large because there's an opinion that maybe we don't have the fiscal discipline or whatever the case may be. Our bonds are just we have to pay a higher interest rate to get people to buy our bonds right now. They're deemed to be more risky, right? So if we can work through that, there's some things that some people are working on that spread may come down. It's already come down a little bit. That would also be another win. So it doesn't mean the Fed just has to lower rates. There's two ways to get decreased mortgage rates. So hopefully if those two can work in concert, that could be really good. All right. 2025 housing market forecast. They are predicting an increase in inventory. And I've heard this from quite a few people that, people are getting to a little more normalized state. Sellers are realizing that waiting to sell their home until they can buy another home at 4% is just not probable. And some people do have to move for a wide variety of reasons. A lot of companies are in both, public and private sectors are really requiring people to get back to work. You may or may have not seen the tirade that Jamie Dimon went on the other day, talking about everybody getting back to work. That's a little bit more common right now. So people are having to move sometimes to get the right job. For a while there, everybody's working from home. So the requirement to move to get work was a little bit out of the system for a while. And now it's starting to become reality again. I think there was a time there when you just had to be open-minded to moving if you wanted to get the type of job once you achieved a certain career level, and that had gone away. But I think that's starting to come back, and that's why I think you're going to see a little bit more inventory, even if rates don't come way down. Anything to add to that?
Nope. That looked well done.
Did you see Jamie Dimon talking about getting back?
I know. I haven't watched it yet. I haven't watched it yet.
It's a little bit funny. If you want to see somebody not appreciating working from home anymore.
I am going to watch it for sure.
Yep. Yeah. Okay. So NAR reveals its 2025 predictions for the 10 hottest housing markets, and look at who's right up there. And San Antonio.
Yeah.
So, and a lot of in the South, although Houston, Dallas, Austin, not on this list. San Antonio, the one, if you just looked at the numbers as they sit today, you might think is the more challenged market. But whenever you look at anticipating where we go in the future, San Antonio has a lot of metrics. And whenever we get to the last report, the affordability index, I think that will resonate why San Antonio is being picked by groups like this. This is a huge group. Right? NAR has a lot of economists, highly reputable. Their predictions are normally pretty darn accurate. So that's a very exciting thing for San Antonio.
Yeah. I mean, I look at the bottom. I was trying to read where they came up with these numbers. Job growth, share of inventory, migration to population. So people are moving here for different reasons. Like you said, you don't see, You don't see Houston or Dallas on there. They've had quite a run up lately. It makes sense. And eventually, there's going to be some kind of correction. So you see like a Boston in there. I am curious. I didn't quite. I couldn't. Maybe you can figure this out. It says all areas offer a favorable financing environment with low proportions of locked-in homeowners or low mortgage. Okay, so basically, I guess what it's saying is that there aren't a ton of folks sitting on 2% in these markets. So people either bought, probably, refinanced or bought after rates went up at a higher percentage here. So they have more people that I guess are willing to part with their mortgages, which is what you need to get access to those houses, right? So
yeah, that's what I take from that too. Yeah. That's pretty readily available info. You can see what the average mortgage rate is in an area, or median, average and median, and see how many people are, to your point, not at a 2.75 or 3, and really have a hard time giving that up.
Yep. Or at your point though, like when rates drop, it's gonna not only will it help new buyers, but people that are sitting on those 3%, they may be more likely to say, okay, let's get out of here so we can buy at a much higher rate or lower rate. I'm sorry.
Yep. Is it a buyer's market yet? And so this is saying this is odd because it's a little bit different than what you saw in the previous from NAR, but a slightly different opinion that there are some buyer opportunities there in San Antonio. So this is saying a buyer's market is defined when months supply reaches 4 to 6 months, and San Antonio is a little bit higher. This says 6, very contradictory to the data that we see coming straight out of San Antonio. So I'm not sure exactly what that means, but I do believe that if you were going to say one of the major metros in Texas that is closest to being a buyer's market, even though their data does not say they have 6 months of inventory, San Antonio would be the most likely, which makes it a spot where investors might be able to get some good deals.
Yeah. I know there's McAllen on there. I can't remember who we were talking to. They said they were starting to do a lot of deals out of McAllen.
Yeah.
So let's get some good deals out there.
Mm-hmm. Sellers inch back into the market. I thought this was interesting. So according to Realtor.com, there were 24.6% more homes actively for sale on a typical day in January, because January is typically not the fastest. Like, it's a slow time for listings, right? This is the 15th consecutive month of annual inventory growth. I think the initial shock of where rates went meant people were buckling down and not being willing to sell. But I do think you're seeing the trend lines here starting to bounce back, and that anticipation of 15% increase in inventory makes sense to me, right?
Yep.
Anything else on here, Jeff?
Nope.
All right. Tell me what your opinion was on this one, the typical down payment.
So, all right. So typical down payment is 16% of home price. It's increasing. This total is increased by 15% year over year in terms of dollars. The typical down payment is $63,000. It's attributed to the increase in home prices. Higher prices reflect higher down payments, obviously. So this goes down all the way from 2019. And it's almost, like I said, peaked. Looks like it peaked a little bit earlier last year, I guess midway through last year. It's just kind of exacerbating what we've been talking about, is that it's expensive to buy a house. Financing terms aren't going back to subprime days where it's super easy to get a mortgage. Mortgage companies are being disciplined. High prices, high rates. It's going to take a little bit to buy a house. That's why we have the I guess glut is what we would call it. But yeah, no, it's coming down a little bit. Hopefully, a little tick down at the end there. But for the most part, yeah, no, it's kind of a big basket. We're talking about it. It's expensive to get into a house these days.
Which means it's good if you're a landlord, right? I mean,
Yeah.
more expensive it is to sell. That means people have fewer options, and it's a good time to be a landlord. Next slide here. 31% of home buyers pay cash. So one thing I didn't see, and I tried to do a little research to see if I could find it, is what percentage of those were like investors,
Most months.
and what percentage of those were owner occupants. But with the appreciation that we've had, if somebody is willing to go, maybe move to a different area, a lot of people are moving from those more expensive coastal areas to places like Houston, or even less expensive like Tulsa, Oklahoma, or Wichita, Kansas. I think that there's a lot of people who may be owner occupants that are paying cash, but I also think there's a lot of investors probably paying cash. I mean, everybody hears how many homes BlackRock, State Street, and all these other companies are buying out there. And I think a lot of times they are using cash, and then they probably roll it into some type of financing after the fact. They may be closing with cash up front. And that is, whenever rates get a little bit higher, that often happens. I think that is going to shift back down whenever rates come back down, right?
I didn't even think about the BlackRock thing, but the other thing I thought about was during COVID, right? There was everyone, like you said earlier, people started working from home. They realized they didn't have to live on the coast and pay exorbitant mortgage payments. So they sold those houses, probably got a ton of equity, and bought a lot of their houses cash because they could, right? So I think the combination of these large hedge funds getting into investing, along with the kind of COVID phenomenon of people moving from the coasts where they're selling these really expensive properties to maybe cheaper areas and paying cash, I would be really surprised if historically it's been this high. It just seems like a really high number right now for both those reasons.
Next slide. And I think the reason we wanted to bring this to light is that some people have been talking about the decreased number of housing starts. I've seen a couple of people out there that covered this saying that, but it wasn't unusually cold season in January, and even in February, especially here in Houston, but across the country. So I think that had a good bit to do with it, and that makes sense. I don't know that there's just this perception out there that real estate market is not as promising as it was a little bit earlier, but I think that the frigid temps could have had a big impact there. So I do want to see what happens in the next couple of months when things warm up. I tend to think that those starts are going to pick back up.
Yeah, I never would have thought about the weather. I know we talk about it's expensive to build these days because of materials and whatnot, inflation. Although I was looking at a deal, somebody was buying a house, new construction. He was basically buying a spec house. The cash out of pocket was a little bit higher, but it was cheap. It was relatively cheap. Like it was less than $200,000. I was shocked. Now, don't get me wrong, it was a small house and not the greatest neighborhood, but it was a tiny little house. They bought new construction. So, those numbers can work in some situations. Most of the time it's rare, and usually you're way more likely to just do it the old-fashioned way, buy a house, fix it up, and rehab it and refinance it. But there was a couple. I was pleasantly surprised. There's a couple little pockets where you can buy these houses really cheap.
Right. So this is saying that this could be the last year of inventory shortage. January was the closest the housing market has come to 4 to 6 months of inventory since 2019. So the market is not moving as quickly as it was before overall, which often presents opportunities for investors as well. And although experts project that if rates settle near 6%, which is not a huge shift from where we are today, that those trends will reverse. And I think that's what everybody's feeling. Like if rates come down, reasonably, we're going to see a big boost to total transactions, right?
Yeah, I think, and we always look at it. I don't know if it's on this presentation or not, but just historically, if rates get back down to 6%, I mean that's a rate. When I was first in the business, that was like a normal rate. That's just The days of 2% and 3% are long gone, in my opinion. This is normal.
Uh, I didn't remember seeing this one before. Maybe I don't know. Is this one that you wanted to add, Jeff?
No, I think David snuck this one in on us.
Okay. So I did look at it briefly, and I guess the question is, will tariffs harm home price affordability? I don't know that these tariffs are not just threats at this point that may not be there for very long. But now the good thing, if let's say that they did go into effect and they did increase the prices on, heavier construction materials, i.e. wood, things like that. I think that's going to increase the price of new construction, which is, most of our investors are not doing new construction. Most of them are doing fixed to rent, fixed to flip. So if home prices go up, but we can still not have some of the more expensive categories that impact things, then that could be a big advantage for buy and hold investors that are doing more of the paint and lipstick stuff. We'll see. I think a lot of the things that are stateside are the less heavy things that go along with new construction. So that could actually be an advantage for the buy and hold. I don't know if you see any other data here, Jeff, that jumps out at you.
No, I just noticed the last little bullet point. It says home builders are prepared for a tariff possibility and are pre-buying lumber, diversifying supply lines. So I would be surprised if this materialized to anything.
Okay. All right. What do you think about the rent rates for December?
So single family rent growth averaged 2.6, 2.6 overall in 2024. The increases are moderate. Rents have continued to increase at an average of $100 per year for the past 5 years. Houston is 1.9 increase. Dallas is a 0.4. That must be year over year, which I guess makes sense because of what we're looking at, because Dallas was pretty flat over the year. But this is kind of exactly what we've been talking about, right? Increases are moderate. Rents have continued to increase at an average of $100 per year for the past 5 years. So when you're looking at deals, it's a balance between cash flow, equity capture, cash out of pocket, all those things. But consistently, certainly in Texas, you can assume nice steady appreciation in the rents. They have bumps in the road, like I said. Some are flat, some are higher, but over the long haul, you're going to get about $100 a year. So when you're analyzing those deals, maybe you're getting very little cash flow, but your out of pocket is next to nothing, right? It's extremely low. Take this into consideration. You're right. Be malleable with what you look at. Don't always, whatever you learned 5 years ago or 10 years ago when you got into the business, that may not be the rules today. And if you stand firm on those things, you may miss out on a lot of good deals. So I'm not saying buy everything. Don't be stupid. Don't buy a lot out of pocket, no cash flow. Like, there are bad deals out there. Don't get me wrong, but don't get so rigid in when your expectations on certain metrics. If 4 things are good and 1 is bad, don't focus on just the bad.
Yeah, I'll add to that. I think that's great. Those are great points, Jeff. That cash flow is too simple of a metric to make a good evaluation of deals. ROI is the right evaluation. I see too many people that are like, $150 cash flow, that's not worth it to me. And we have very savvy, well-capitalized investors that have been doing this for a while that are buying those $150 deals up all the time, but they're also getting less out of pocket on a $150 cash flow deal, right? So ROI, return on investment, is really what you want to look at, because the cash out of pockets are about half what they were whenever cash flows were 300, and you get 2 homes, and you can refinance that rate at a later date. So I think really focusing on ROI and the opportunities to refi at a later date, that's a pro move, and savvy investors are doing it. We were talking about this yesterday. I do feel like fewer people are in the game at the moment, fewer newer people sometimes, but I think the people who've done it in the past realize that now's a golden opportunity, and that savvy investors are out buying a bunch of homes right now. We have one of our loan officers who's done 16, 17 homes in the past seven months for a borrower. So it's for people who really know what they're doing. I think they're getting in for sure.
Yep.
Next slide. This rental vacancy rate has been an interesting trend. The vacancies were way down for a while. They're creeping up a bit. I mean, still historically, they're strong. This is a great trend for landlords, that whenever the vacancy rates are low, that means your properties are more consistently rented out. You're collecting cash flow. There's fewer gas in time whenever it's vacant, but there is a little bit of an upward trend there, and that may mean it's simply that there are more people who are dipping their toes back into purchasing instead of renting, because they're starting to accept where rates are. But I still think that these numbers are very good relative to other historical periods. So an upward trend, something we want to keep an eye on. But still, if you take the average, I think it's still well below the average.
It's just a trade-off, right? When rates get low and it's easy to buy houses, you're going to have to deal with a little bit more vacancy, but you have low rates, right? So you can have higher cash flows. So the trick is when the vacancies are, knowing what market you're in. So if the vacancies are starting to creep up because maybe it's a little easier to get into a house, try to be a little smarter with your leases. Try to sign some longer term leases. Maybe take a little bit less rent, maybe a tiny bit less cash flow, to ensure that you're going to have somebody locked in, maybe say for 2 years instead of 1, or just kind of know what you're dealing with. Because I always, when you're looking at rental properties, if you miss out on 2 months, that could wipe out your entire year, right? So just be smart about what's out there. If vacancy is on the rise, be a little more astute with who you pick. Try and negotiate a little bit longer leases.
Yeah, some simple math to your point, Jeff. Let's just say you're renting out a property for you think you're going to rent it for $2,500 a month, and but it looks like the high side is maybe $2,400. They're trying to squeeze out $2,500. When you're talking about getting an extra $100 a month for 12 months, that's not that much money, but you're going to lose out on $2,500 every single month it's not leased. So you want to, there's a lot of what most people say to be a good single family or 1 to 4 landlord is that you want to have a very strong product. You don't want to overbuild it for the neighborhood, but you want to do it very, very well, like in line with the top of the market, not overdone, but in line, and then price it slightly below the top of the market. I mean, I'm not talking a ton, 25, maybe $50. But if you get that thing leased right away, you get an extra month of $2,500 instead of trying to eke out an extra $50, which if you spread that out over a year, it's $600, right? It's not that much money, and it's way worse to miss out on an entire month of rent. So that's a pro move. Yep. Don't try to get greedy over $50. Get it leased, right? Get it leased. Plus,
you miss a month, you can't make it back.
There's a lot of bad things that can happen whenever a property is vacant. You can have water pipe bust, you can have a fire, you can have kids break in there, vandalize. Like, there's all types of things. You want to get it leased. There's no doubt about that. Getting it leased is a winning formula. So don't major in the minors and worry about $50. Here the Texas trend is in line. It's up from where the national. It's kind of like the same basic trend line, right? Seems to be pretty similar. Vacancy's up a little bit from where it was, and that's, I think, to be expected after that COVID rush. So, Jeff, what are you seeing on the interest rate trend?
Yeah, I mean, like I said, rates in January 6.95, almost 7%. So, I think if we go back to one of the previous slides, I think they say 6.3 is what they expected. So, they expected to go down slightly, but again, it's not. If you look at the outliers, 17 is an outlier for sure, but so is 3. So is 4. Those are outliers. It's the bulk of the interest rate period since the 70s, right, has been living in between that 5 and 10%, like almost all of it, except for those the 20 to 10 period, or 10 to 22 period. and then the 80s, right? The early 80s. Other than those two little periods, everything's between 5 to 10. We're at 7 now. Maybe you can go 6. So this is just kind of a normalized number right now. It's a shock to the system. Things have to kind of resettle and adjust. I think that's kind of what we're doing.
Yeah, for sure. So this is always our favorite slide, and I like to deep dive these numbers. We have a pre-COVID number year over year, like looking back to February 2024, and then also February 2025. We really look at these, the major metros in Texas versus the other major cities in the country. And I love to look at San Antonio, because San Antonio, whenever you see those numbers that say it's such a great opportunity, you look at this San Antonio average home price back in February 2019, it was like $217. Houston's $299, Austin's $389, Dallas is $317. All of those are some of the less affordable, markets in the country. But when you compare them to comparable cities, right? Comparable cities, it's compared to New York, Los Angeles, Miami, San Francisco, big, huge cities, comparable to the amenities you'd have. It's super affordable. Like, it's unbelievable. We're not talking 500 like Miami, 905 like LA, 900 like New York. Like, it's not even comparable, right? And the affordability, these other areas, you're having to spend 80+% of your overall income on a mortgage payment, whereas in Dallas it's 43. It's 39 in Austin, it's 38 in Houston, it's all the way down to 29.59 in San Antonio. Then you look to currently, the positions have moved a little bit. Dallas is 20 versus 22 back then. Austin is 29 versus 28. Not huge moves. Houston was the 29th least affordable city. Now it's the 32nd least affordable. San Antonio was 58. Now it's all the way down to 66. And one big driver of that, I think, is the income in San Antonio has really gone up quite a bit. You're looking at $63K versus $49K just a couple years back. And that $63K is just a shade less than Houston, right? Like under $1,000 less different. But the average home in San Antonio is $278. The average home in Houston is $359, almost $90K more. So San Antonio is very affordable relative to the average income.
It baffles me because, like you said, you look at the income back, 19, the Houston income and San Antonio income are basically the same, yet Houston houses were 80 some odd $1,000 higher, or 24. Houston 61, San Antonio 60. So basically the same again, but you got 350 versus 265. It's the same way. Like, to your point, the income is, I'm not sure what the deal is with San Antonio, why it's so undervalued. I mean, I guess I could say the same about all the cities down there at the bottom of the list. But yeah, it's a big city too. There's a lot of amenities. I just kind of was looking at Cleveland. Holy cow, 139.9. Did not realize the average price in a house in Cleveland is less than 150K.
That's a
low number.
Rare sight. That's a rare sight for a city that has like sports teams.
They got all the teams.
They got all the teams.
Every team.
Yeah, I know.
Go to Cleveland. I mean, I've never been to Cleveland. I don't know what it's like, but they got all the teams. So yeah, I was looking at LA. One of these days, it's going to eclipse 100%. I know it will. At some point, one of those cities is going to go over 100%. LA's close. We're right there.
It's hard to figure out how to balance the budget whenever your mortgage costs.
Talk about haves and have-nots.
Yeah.
Just look at that top list, right? Because there's a lot of people who live in LA, but I don't think a lot of people live in a house worth $1.1 billion. That's a lot of renters.
Yeah.
A lot of renters.
Yeah. So at the end of, I was going to make one other quick point, and then we can go on. Yeah. One other quick point I did want to make is just whenever you're looking at Dallas, it's a little bit deceiving because Houston, all of Houston is baked in there. Some of the less expensive markets, but Dallas is kind of separated out. If you look at it, you got Irving there, which has a lot higher income.
Yeah.
And
Fort Worth.
They
look at Plano. bunch of different little markets up there.
Yeah, so that's a little bit deceiving. I actually think Dallas is whenever you combine all those different areas, you know, you gotta look at Dallas a little bit differently than you do
It's
Houston.
more affordable than that list.
Yes, I would agree with that.
20 is, 20 is too high. It should not be at 20. It should be a little more affordable than that for sure.
Yep.
It's a good point.
Couple of things I do want to mention just before we wrap up, and we get into some questions. We do have a couple of off market deals that we're going to be putting out. So if you have any interest in getting an off market deal in Houston or in San Antonio, please reach out to us. We're going to provide the contact information here in a second. But if you want to find out about some off market deals, and then also, of course, we can lend on those deals. That's our primary business, but occasionally we do take over a property, or maybe we have someone who wants to market one through us as a company. And so if you want to find out about some off-market deals, do please reach out. Best way to reach us, 832-699-6960 or at catalystfdg.com. And you can, of course, use that to apply if you want to do that. David, I think we may have a couple of questions. We've got a couple of minutes to answer a few. And then we also have a drawing for today. Do you want to cover the drawing then the questions?
Sure. Yeah, I can do that. So our drawing winner today is going to be Michelle Ziebert. So Michelle, congratulations.
Michelle.
Congratulations, Michelle. Look forward to hopefully doing a deal with you.
There you go.
Absolutely. And so for our questions, just a couple here. One question was, where are investors currently getting deals right now?
It's a great question. It seems to me like some of the better deals are coming a little bit further outside of the major parts of the city. Certainly not in Houston inside the Loop, or in Dallas and in downtown Dallas or anything like that. Those areas are the prices are really going up, a lot of gentrification. But what we're seeing is, like, if you go in Houston as an example, you go a little bit outside the Beltway, right? You go into like a Porter, Texas, or you go down to a Leak City, Texas, or you go down to Pearland or something like that. A little bit further outside, people are getting some outstanding deals. Up in Dallas, you're seeing the same thing, all the way up into the Texas-Oklahoma border, some hot deals. That's been an ongoing trend, and I think that just makes a lot of sense. Home prices are a little bit less expensive, and people can still commute to a lot of great jobs. If you think about, it's not a time where every job is in downtown Houston or downtown Dallas. Like, there's the energy corridor outside of the west side of Houston. You got the Galleria. People, they got great jobs in the Woodlands even. So people could commute to the Woodlands, which there was a time when everybody commuted from the Woodlands to downtown. But now people are commuting, moving from Montgomery, and they're traveling into the Woodlands as an example. So I think going further out, people are getting some great deals out there. I mean, amazing low out of pockets that we're seeing from investors who are willing to go a little bit further out.
I think, and correct me if I'm wrong, but I was talking to somebody or read something. I think it's Liberty County on the northeast side in Houston, which has not historically been the best, but it's really starting to get some action. Like, a lot of good deals up there. So to your point, if you're willing to go a little bit further, and Liberty isn't that far, honestly, but if you're willing to go a little bit further out, that's where a lot of the best deals are happening.
Yeah, for sure.
Gotcha. And another question that we had is basically someone that's self-employed. They were wondering what loan products that we would have that would kind of get them into investing or get them started in their investing journey.
It's a great question. And I'm going to give Jeff's voice a break. He was kind enough to grace with his presence today, even though he's not feeling great. So I think that, just because you're self-employed does not mean you can't qualify for a conventional exit loan, right? And our loan officers and our team are excellent at really evaluating your income and seeing if there is a way to qualify for conventional loans. There's a lot of add backs that you can add back. People might take depreciation on certain things, or they might write off certain things that if you have an experienced loan officer, they can add those things back and get you qualified for the best possible product. That said, if you still don't qualify, and you're doing this with the same loan officer, right? With Catalyst, the same loan officer that you apply for a DSCR loan, which we'll talk about in a second, or conventional loan, same loan officer you apply for a hard money. So you reach out to us, we let you know what you can get, your terms on hard money, and the terms on your exit strategy. We let you know all of that at the same time. So you reach out to somebody and you're like, hey, I'm self-employed. Maybe you qualify for conventional. You don't know. But if you don't, we can very easily, with the same credit pool, same loan officer, move you into a product called a DSCR, a debt service coverage ratio loan. We have some excellent products in that DSCR space, and you're allowed to really get qualified on the property's ability to cover the mortgage rather than your own ability to cover the mortgage based on the income that you earn from a job or your self-employment. So for people that write off a lot of things, maybe they don't have consistent employment. Maybe they're a full-time home flipper, or they're a real estate agent who doesn't have easy to document income. For people like that, it's great. Or some people that just max out their 10 Fannie Freddie deals, because you can only do 10 Fannie Freddie deals in each person's name. So a lot of people will transition to doing these DSCR loans after they max it out. The good news is, whether you're wanting to do one deal and you don't have documentable income, or whether you're an investor who wants to add 30, 40, 50 homes, there are products that help you do that. And with Catalyst, our very experienced loan officers will steer you down the right path. You call up with a need, they'll help you figure out how to meet that need.
Yeah. I get this question all the time. So just to be clear, Catalyst does hard money and long term. So if you need one, either or both, we can do it.
Absolutely. Thank you very much, Jeff, for muscling through your voice challenges today. David, thank you for organizing again. Everybody, you have a great day. Happy investing. Look forward to talking with you.
Thanks, everybody.
See you guys next month.
Yep.